JPX Energy Market Weekly Updates. Oil prices got off to a weak start to the year as economic concern grew further, with the IMF forecasting a third of the world's economies could sink into recession this year. Intermonth spread of major crude oil benchmarks drifted lower last week, with NYMEX WTI first month and third month spread hovering around two-year lows, while JPX Dubai has shown some resilience. The front month and third month spread of NYMEX WTI have flipped between positive and negative since mid-November, leaving a narrow spread since the start of 2021 on Friday. Furthermore, spread for the first half of 2023 crashed into contango, with the front month's June contract showing a negative structure on Friday amid an expected continued slide in the U.S. refinery demand recently. U.S. refineries are usually destocking at the end of the year when oil prices rise year on year because they need to keep inventories of raw materials as low as possible by the end of the year to make their earnings look better, according to accounting rules. Refinery buying interest is expected to come back sometime before February. The EIA did reported the U.S. crude oil inventories rose by 1.7 million barrels for the week ended December 30th, in large part due to refinery shutdowns amid freezing temperatures from the week prior. We'll probably see an uptick in refinery runs next week as the largest crude oil refinery in the United States returned to production. The crude build was also likely blunted by continuing strong exports supported by healthy arbitrage economics for flows to Europe. According to Standard & Poor's Global, European refiners turned to crude grades from Norway, the United States, and Saudi Arabia in 2022 to plug the growing gap left by Russian imports. Among these grades, flows of U.S. light and sweet WTI crude were the next biggest stand-ins for Russian barrels, adding almost 200,000 barrels per day on balance between WTI and WTI Midland loading exports. The front month and third month spread of ICE Brent also dipped as European crude oil market is looking better supplied in the near term, and risks are likely skewed to the oil product side. Data from Vortex shows that Europe's imports of diesel and gas oil from the United States is on track to reach a two-year high this month, while in December, Europe's U.S. loadings for diesel and gas oil reached 660,000 tons. It was the highest amount headed to Europe in any month since September 2020. The EIA data also showed a decline of 1.4 million barrels for distillates due to lower refinery runs. Now, U.S. distillate inventories stand around 7% below the 5-year average. For the United States, the increase in European imports have collided with falling refinery supplies. Prior to Russia's invasion of Ukraine, the U.S. was importing nearly 700,000 barrels a day of petroleum from Russia. Most of these imports were finished products and refinery inputs that boosted distillate supplies in the United States. The loss of these Russian imports have caused problems for refiners as they struggle to fill holes in their product slates. From February the 5th, all remaining imports of Russian oil products must be halted in the European Union as part of the sanctions. The competition for non-Russian diesel barrels will be fierce. It's expected that Atlantic Basin diesel markets will be tight until this summer, with refineries running at or near full capacity for months. On the market east of the Suez Canal, China has increased its fuel export quotas by as much as 46% for the first batch of 2023 allocations compared to the first batch of 2022. The latest batch of fuel export quotas signals China's willingness to continue supporting refinery throughput and capturing good refining margins in Asia. To sum up, we expect global refining industry will like to shift near-term production towards middle distillates to capitalize on high crack spreads for diesel and jet fuel, driven by inventory shortages at key international hubs. Crack spreads should gradually move closer to normalized levels during the second half of this year as a result. However, a rapid increase in middle distillate inventories to historic levels is unlikely given the size of the current gap. The intermarket price spread have shown a similar trend as incremental demand shift eastwards. The Brent in Dubai spread widened sharply in 2022 as the Russian-Ukraine war in February boosted Brent prices. However, the Brent in Dubai spread is likely to narrow this year as refineries coming on stream in Asia-Pacific and Middle East Gulf will run on the diet of predominantly medium heavy sour crude, while supplies may tighten if OPEC+ keep cutting production, which could underpin Dubai prices. Okay, that's all we have for this week. Welcome back next week.